Good morning, everybody. Well, it's getting a little later. Yep, going to run through a tax update. Going to look at a couple of the Inflation Reduction Act that passed federally recently. It had a lot of energy credit updates. We're going to look at some of the ones for the EV vehicles, the charging stations, the ones that are really popular right now and relevant for you guys. There's a couple other federal provisions. We'll touch on ERC a little bit. There's some changes with deductibility of interest expense. Bonus depreciation is supposed to be phasing out over time. Look at some of those items. A brief look at year-end legislation outlook. There's not too much of an appetite for it, but there might be some lame duck legislation that could hit on some tax topics. And then Massachusetts, we're in Mass, so a couple items there. So the Clean Vehicles Credit, or it used to be called the New Qualified Plug-in Electric Drive Motor Vehicles Credit, or the EV Vehicles Credit, however you've heard it before. It used to be base $2,500 credit up to $7,500 based on battery capacity, and then certain manufacturers, I think GM and Tesla, had hit their 200,000 vehicle limit, so they weren't you couldn't get a credit on those vehicles any longer. When the Inflation Reduction Act was signed in August this past year, it created an immediate requirement that from that point forward, all vehicles sold to get the credit had to have a final assembly in North America. There is we do have a link for it too. There's a page that has a listing of all vehicles for 22 and 23 that are supposed to meet that requirement, and then there's also a VIN lookup tool, so you can look up based on a particular vehicle to see if it falls within that criteria. The new credit, which will be starting in 2023, it'll also be up to $7,500. As Bob was saying before, there's two kind of requirements there. There's a mineral requirement for the battery, and that it has to either be satisfied by in North America or by a free trade agreement partner, and then also battery components requirement. We'll have to kind of see what information comes back, I would think, from the manufacturer to kind of confirm whether or not it's meeting that criteria. As Bob also mentioned, the percentage that has to meet that North America requirement is going to scale up over time. So it's going to be kind of a challenge to see right out the gate in 23 how many vehicles are going to be eligible for this, or if there's going to be a little bit of a wait time on that. This as a side too, this credit has also kind of caused a little bit of a world trade disruption. So, like for example, I think Macron from France came down in this past week or two, and they're talking about how there are now these incentives for EV vehicles specifically assembled in North America, battery North Americas, and it's kind of causing friction with some of the EU trade partners. So. We might see some change at the federal level to ease off. I know there's been some talk of maybe pulling back for 5 years or so on the North America requirement. As of now, it's still in place. Have to kind of see where that lands. Unlike before, there'll now be a price cap on the vehicles that are eligible for it. So MSRP for vans, SUVs, and pickups won't be able to exceed $80,000 and $55,000 for all other vehicle types. For individual, person that walks in to buy a vehicle, there will be income limitations. The way that this should work is that, because following with this last bullet, where basically the consumer will be able to come in, they'll be able to purchase the vehicle, and starting in 24, say they are entitled to a $7,500 credit. It should work in the way that the dealer can provide a $7,500 credit against the purchase price of the vehicle, and then the dealer will register with, I believe, the Secretary of Treasury to get a direct refund of that amount. So in other words, it kind of accelerates, instead of the taxpayer consumer taking the credit on their tax return, they would get the discount credit up front when they're purchasing the vehicle, and then that credit would then flow through to the dealer. We don't have the requirements exactly on the registration, but the dealer, you would have to register through the Secretary of Treasury to be eligible to process the credit this way. And it does have some language in there about reports that you're supposed to submit in. Basically, I think the idea is to accelerate so that the consumer can get the credit right up front when they're purchasing the vehicle. If they don't meet, for example, the income limit requirements, it should be at the consumer level when they go to do their own tax return, you know, say they're over the $300,000 income limit. If they took the credit when they purchased the vehicle, the way the text is written, it looks like they would then pick up that credit they weren't supposed to get on their personal tax return, and you know there won't be a requirement that a dealer would have to, you know, get the consumer to attest to saying, oh, you know, my income level is so and so. But basically, 7,500 would stay, changes on the requirements, and the 2024, the advance payment, that'll definitely be a big item. The previously owned clean vehicles credit, it's essentially a smaller version of this last one for used vehicles. This one will start in 23. It'll be equal to the lesser of $4,000 or 30% of the sales price. So if you do the math on that, the max credit comes in around $13,500 on the sales price. The sales price of the vehicle can't exceed $25,000 or else the vehicle will be ineligible for the credit. There's some lower income limits on this one. For single, $75,000, and they're buying EV, so just see how that'll work out. The model year of the vehicle will have to be at least 2 years earlier than the calendar year of the purchase, so in 23 it would have to be a 21 used vehicle. It's only available for the first resale of the vehicle, and the buyers can only claim it once every 3 years, so it can't be something where consumers coming in and churning this credit frequently. They'd only be able to claim that credit once every 3 years. There will also be that same, as I described before, where you can take the credit against the purchase price, and then the dealer will be able to actually receive the credit. That'll also be available for this previously owned. So basically, EV and now used EV are going to have these credits, and it's going to run through the sales price, and then the dealer will have to collect the credit. It won't be mandatory that it has to run that way, but that'll be an option for it, and it'll probably be advertised that way. You know, come buy an EV car and getting, you know, an immediate $7,500 off the price type of thing. Commercial clean vehicles, so this would be probably business entities coming in to purchase business vehicles. Also new in 23, it'll be equal to the lesser of, so it's either 15% of the vehicle cost or 30% of the vehicle cost if it's not gas or diesel powered. So that's one. Or it'll be the incremental cost of the vehicle. And what that would be is you look at a vehicle that is not gas or diesel powered, and then you look at an equivalent of that vehicle that is, and whatever the incremental cost differential is between those, that's one of the thresholds. So you would look at that difference versus either for 15 or 30% of the cost of the vehicle, and that's the max of the credit. Whether I'm hoping that for the incremental costs there might be some like baseline, because it doesn't specifically say that it has to be that same model of the vehicle, just, you know, using electric charge. It just has to be a similar model. So I'm not sure exactly. We're expecting some guidance on this to come out probably by year end. The max credit for vehicles with gross vehicle weight rating of 14,000 or less will be 7,500, and then for the heavier, it'll be up to 40,000. And the vehicle must be acquired for use or lease and subject to depreciation. So again, just essentially meaning that it has to be a business use vehicle, and this won't be available for just personal consumer use. The alternative fuel refueling property credit. So this is like the charging stations. Previously, this was equal to 30% of the cost of the equipment, up to $30,000 per location. So this would mean that if you bought multiple charging stations within one dealership location, you were capped at $30,000. Going forward to the new 2023 credit, It'll be a max credit of 100,000, and it'll also be limited on a per unit basis. So, in other words, whereas before maybe you bought five units and they would have qualified for multiple credits, you were capped at 30,000 per location. Now you can get a credit on each of those charging station units up to 100,000. The credit amount will be by default it'll be 6%, but it goes up to 30% if certain prevailing wage requirements are met for the company that's actually installing and building the charging stations. There's also going to be this small amount of time. So there's, for the prevailing wage requirements and some apprenticeship requirements, there is a little bit of a lead time where recently, a couple weeks back, the IRS put out some initial guidance on this. And from that time till 60 days later, if you start a project within that time frame, you can still get the higher credit amount, even if it doesn't necessarily meet that wage requirement. So this might cause, or this might make it favorable for the month of January to look into these credits, depending on how easy it'll be for the charging station credit companies to meet these wage requirements and apprenticeship requirements. I would think that they'll probably look to meet that, because 6% versus 30% for a credit is a big swing. But it is something that if you're looking to get it early in the year, then you wouldn't have to worry about that factor. And then a last piece, it's only available if the property is placed in service within a low income or a rural, or it says a non-urban census tract. That's a new requirement that wasn't there before, and that's of course something to consider. We're hoping that with the guidance, there's kind of it lays out exactly which census tracts you can follow to know whether or not you meet that requirement. We're still kind of waiting to see on that. Some other credit items related to energy credits. Solar panels, some companies have been doing solar panel credits. That credit was phasing down to 26% in the recent year. It's been restored up to 30% for most smaller projects. So if you're doing a project less than 1 megawatt, you can get the 30% credit on the solar panels. The non-business energy property credit, just throwing it in, this is for if you're your actual residence, if you're upgrading your windows or your doors, anything like that. There used to be a lifetime credit cap on that of $500. So if you already put in energy efficient windows, you wouldn't be able to get anything anymore. They've now changed that to a $1,200 annual limitation. So I think the idea is make some changes over time each year, and you can get a credit on your personal tax return for making those. And then certain of these energy credits, like the solar panels, you can, if you don't have a tax liability in the year that you claim the credit, you can carry it back against previous year tax liabilities. And there's also some availability to, if you purchase these and you won't be able to utilize the credit, to sell or transfer the credits as well. LIFO relief, and I'll get into this when I touch on the legislative outlook. It's not totally, the chances of this happening are still, they seem pretty low at this point. What the LIFO relief would do is, during, coming out of the pandemic, it was difficult to restore inventory, and if you were on a LIFO basis, if you depleted your inventory, there was a large recapture of income because the value of your inventory had been valued low, and you were selling those vehicles at a large margin, and this caused some dealers to have a large recapture of their LIFO inventory income. There have been, both in the House and Senate, proposals that would allow dealers up until 2025 to replace their inventory, and instead of having to pick up all that income for most dealers in 21. Since that year has already passed, most of the tax returns have been filed, there should be an option, it's called 481A adjustment, where you can make the adjustment to account for this differential in income in a future year instead of having to go back and amend your tax returns. That's in the versions of the bills that are out right now. For any dealers that had elected out of LIFO or off of LIFO entirely. This probably won't be available because when you make an accounting method change, such as changing the way that you value your inventory, you typically have to wait 5 years for any change back. So you wouldn't be able to switch back onto LIFO to get the benefit. Interest expense limitation. So there's an interest expense limit code section 163J, which stops the amount of interest that, or limits the amount of interest that you can deduct for the entity. Floor plan interest is fully deductible as an exception for the dealer industry. But what happens is so say the way that this would function is you look at what your taxable income is, and you can't deduct more than 30% of that. Whatever that number is, that's the cap on the amount of interest that you can deduct. If it's floor plan interest, you can deduct it regardless, even if you exceed that threshold. Whether a dealer can take bonus depreciation or not, though, which is the ability to write off an asset immediately in the year you purchase it, whether or not the dealer is eligible for bonus depreciation hinges on whether or not taking that interest deduction on the floor plan interest is just because of this special exception for dealers, or if you had enough income that you would have been able to deduct all your interest regardless. What's happening this year is normally you would have your income number, and you'd be able to add back to that any depreciation expense that you've taken, which would obviously make it easier to deduct all of your interest expense. That's no longer the case for 2022. This is one of the items that they're at least looking in the lame duck session to see if they can get this changed, along with bonus depreciation, which is scheduled to start phasing out, or at least phasing down next year in 23, down to 80%. So both the bonus and the interest, they're trying during this lame duck to maybe get something in to push this out, probably to 2025, to stop these changes. So that would allow you to continue to take 100% bonus and continue to be eligible for bonus or deduct all of your interest. Employee retention credit. So people are familiar with the payroll tax credit. You can either qualify for it if you had a significant decline in gross receipts, looking at your 2020 or 2021 revenues versus your 19 receipts and revenues, or you can qualify if a qualifying government order caused a partial or entire suspension of your business. The credit may be claimed through April 24 for the 2020 credit, and then the larger credit, the 2021 credit, that can be claimed out through April 25. So we're just starting to hear now about the audits on these credits are starting to happen. I haven't heard the results of any of or I haven't seen the results of the audits yet. I would expect that over probably the next year, we'd see the results of these audits. Maybe there'll be some pushback from taxpayers trying to take the IRS to tax court on adverse decisions, and we'll have a better idea as to what exactly, what'll fly and what the IRS will or will not challenge. Because when it comes to, for example, the supply chain, the government order shutdown, where it can be an aggressive position is you can take the credit during a period that a government order is in place. So if a government order is in place saying you couldn't operate your showroom, then you could take the credit at that point, even if you were operating repairs and maintenance. Where some of these credit companies are what they're hanging their hat on is they're saying, okay, well, towards the beginning of the pandemic or sometime during 2020, there were government orders in place. This caused a international trade disruption, which has then continued to radiate through to 2021, and it's preventing dealers from replenishing their inventory or for the suppliers from being able to provide the parts and cars. Where it's a little bit risky is if now you're looking in 2021 and you're trying to claim the credit because you weren't able to replenish your inventory, but if that shutdown order has since expired, that's where we think that the IRS would have some issue with it. Because reading the guidance from the IRS, it looks like you can only claim the credit for like a supply chain issue, that type of thing, if a government order is actually in place for the period of time that you're claiming the credit. So that's kind of even a state-by-state, some local orders. There are credit companies that will obviously look into this credit for you. I would just advise that if you do reach out to them on this government order shutdown, just have an idea as to what services they actually are providing on this. Are they collecting the 15%, 20% fee on your total credit right up front, or are they going to wait until you actually get that paid out? Do they provide audit protection? That kind of thing. Because some of them are better than others in that when they have a consulting call with you, they'll say, here's the exposure. We found some orders in this time. We don't know necessarily exactly how well this would be upheld, but we've built this narrative for you, and we would try to defend it for you. Or they might just say, here's the credit, give us our cut of it, and see you later, kind of thing. So we do have some contacts if there's anyone that wants to look into that. We aren't doing that government order, but we do know of obviously some dealers that have done that. Remote employees, just because as we switch to a remote working environment, just something to keep in mind. Even having one employee working remotely in another state can potentially cause you to have to register and collect and withhold taxes. Just if you're going through a payroll company, just check with them if you have someone new on payroll outside of state. And then it could cause an income tax filing requirement. A lot of the states will nexus the requirement to actually file an income tax return with the state. A lot of the states will say, if you're doing business in the state, then you have nexus with us. And that's a pretty vague and encompassing thing. And a lot of the times having an employee working in the state would fall within the doing business. So in that instance, if you have a single employee working in a certain state, is that enough to then cause you to have to file in a certain state for income tax purposes, to register with the state, pay the annual filing fees, et cetera? It might be a business decision to discuss with your advisor as to whether you think having that single employee in that state would justify or require you to have to file in those locations. Federal student loan debt relief. This is the debt relief program from the Biden administration. $10,000 of debt, non-Pell Grants, and up to $20,000 for Pell Grant recipients. There are some income limitations: $125,000 for individuals and $250,000 for families. The applications are still open on this. They'll be open through December of '23. Currently, for anyone that has applied for this, I've seen it. You'll get an email that says, we've accepted your application. There's nothing further you have to do. We'll notify your loan servicer, but due to ongoing lawsuits, because they're challenging whether or not the administration has the ability to just kind of unilaterally make this decision to forgive the debt. So right now it's up in the air as to whether or not this debt will actually get forgiven or not. But the applications are still open. If it does end up going through and part of the debt is forgiven, it'll be federally non-taxable. Most states follow that. Massachusetts is one of them. 1099K reporting threshold. So this is just kind of have in the back of your mind. So if 1099Ks, a lot of the time this would be a tax form that you would get if you, for example, payment for services through like a Venmo or PayPal, if you're doing like resale of concert tickets, or if you're selling some personal items online. So in the past, for the federal requirement, this tax form didn't have to be submitted unless there were over 200 transactions or $20,000. Massachusetts did already have the $600 level that is now in place for federal, but whether that was always being followed, it was kind of hit or miss. Just the thing here is, the taxability of those items. Technically, even if you sold something online and you didn't get the tax form, that was supposed to be a reportable transaction on the tax return. Now, a lot of people will probably be getting these 1099Ks that they maybe didn't expect. It could be someone sold a pair of shoes online, or they sold a couple pairs of shoes online. If it ended up pushing over that $600, then now they're getting a 1099 and they're going to have to report that on the tax return. So it's just one of those, if you or someone you know gets that 1099-K form, the threshold to file that has been lowered, so people will get that more often. These are just the inflation-adjusted figures. Basically, you can contribute more to 401K and IRA. Annual gift exclusion, that's the amount that you can gift to someone without eating into your lifetime amount of gifts that you can give. That's gone up as well to 17,000, up from 16,000. So the year-end legislation outlook. So in this lame duck towards the end of the year, right now we're kind of looking at government funding, whether they're going to do an omnibus spending bill to fund through the fiscal year, or if they would just do a continuing resolution temporarily into, I've heard anything from, just pushing out the government funding into like February, March area, for example. But whichever vehicle they end up going with, this is where we could potentially see some year-end tax changes. On the Democrat side, they really want to boost the child tax credit. They want to get that back up to like $3,000, $3,600, get it fully refundable. And then in exchange, the Republicans want Tax Cuts and Jobs Act items to be extended, which would be the interest expense limitation. That's before, when I was talking, they basically want to make it so that you can deduct more interest until probably 2025. They want to keep the bonus depreciation rate at 100% fully expensing, probably again through 25. This is the vehicle where we would see LIFO relief. There's some retirement legislation, and there's an R&D expensing that probably wouldn't be super relevant in this industry. But this is something just to look for if when that big funding bill does go through. This is where we could see a couple tax-related items, but especially going forward with the split House and Senate, I don't think we're going to see any large tax changes over the next couple years. In Massachusetts, excess revenue refunds, so the state had collected approximately $3 billion of excess revenues. So people have been getting the refunds that started in November, either direct deposit or a check equal to 14% of your tax liability on your 2021 tax return. If your dealership had participated in what it is there was a new ability to pay taxes at the entity level for your dealership so that you could deduct it on your federal return. Basically, it was a workaround to a state tax deduction limitation. The whole thing is, for dealers that participated in that, you received the benefit of that up front when you took the federal deduction and the return was filed. So when you get a smaller refund, a smaller 14% back, the benefit has already been received. Basically, the credit that you get reduces the amount of the refund that you'll receive. So if you're looking at your mass tax return, you calculated 14%, and now you get a refund deposited into your account and it's way lower than you expected, it's probably because of that credit. And the benefit of that credit was already realized on your federal return at the time of filing. So there is you get a 37% benefit on the federal side as opposed to the 14% refund side. So it was still beneficial to do this. But that's why some people are getting refunds smaller than expected. And then the mass millionaires tax did pass, so this will establish a 4% state income tax on taxable income in excess of $1 million, and that'll be adjusted for inflation. So that's in addition to the base 5% tax, so essentially 9% on that income over $1 million. This will be effective for the 2023, the next upcoming year. Considerations on this, if there's some income you can accelerate into 2022 at year end that would otherwise push you over the $1 million, that you want to get that before the new rate. In subsequent years, if you going to do tax planning, you're expecting to be over the $1 million. If there are any additional expenditures that you think you can write off or losses that you can accelerate to pull you down from that $1 million. If there's a large, maybe like a dealership sale, for example, looking to see if you can do an installment sale option so that you can receive the funds over a period of years. Massachusetts in particular, you usually, if it's over $1 million for the total gain, you would have to report that all in 1 year, or you would have to post bond with the state. but it's just looking at different strategies, and as Bob mentioned, some people are looking at changing their domicile, moving to a low tax state or a no tax state like Florida, something like that as well. I know I kind of flew through some of that. Any questions, comments on any of that here?
I just had a comment.
Yep.
On light bulb.
Yes.
Just additional information.
Sure.
Talking with NADA this week. On that chart you had things at the top that Congress needs to do. The tax stuff they don't have to do.
Right.
So NADA is looking for an opportunity to tax the movies to Vermont or the light bulb. The couple things you all should be aware of is Lori Trahan, the congresswoman from Westford, northern Middlesex County. She signed on to the legislation, co-sponsor. We got Aubrey Foss from the Newton Brookline area. Very helpful on the issue as well. So we have allies in Congress. And Richard Neal's the chair of the Ways and Means Committee. Hammer him with dealers at meetings over the last 2 to 3 years on this issue as well. So we've been active with our delegation because of their leadership status. Governor, we've had a number of meetings with the chairman of the Rules Committee. So they're well aware of it, and we do have a couple who are active on it for us. So it's really whether the tax bill is or not.
Right. Yeah. Exactly. Yeah. No, there's been kind of bipartisan and bicameral support for it. It just kind of hasn't really made it into a legislative vehicle so far. So this would probably be the chance if there's a tax section in this funding at year end, that's probably a good place for it. All right. Thank you very much.